Question 1. A captive insurance company must maintain certain solvency standards to ensure that it has adequate financial resources to meet its obligations. Under Indiana law, which of the following is true about the risk-based capital (RBC) requirements for a captive insurance company? A. The risk-based capital requirement is calculated based solely on the amount of premiums written by the company. B. A captive insurance company must meet risk-based capital standards that assess its financial strength based on assets, liabilities, and other risk factors. C. The risk-based capital requirement is calculated by multiplying the company's policyholder surplus by 0.15. D. A captive insurance company does not need to meet any risk-based capital requirements if it is structured as a group captive. Answer B. Explanation. Risk-based capital (RBC) is a measure used by regulators to determine the financial strength of an insurance company based on its risk exposure. In Indiana, captive insurance companies are required to meet risk-based capital standards that assess their overall financial strength, which includes a variety of factors such as assets, liabilities, and risks related to premiums, investments, and reserves. This is a comprehensive approach to ensuring that the company can cover its obligations and maintain solvency. Option B is correct because it accurately reflects the nature of RBC calculations. Option A is incorrect because RBC considers more than just premiums, it includes asset and liability risk assessments. Option C is incorrect because RBC calculations are not based on a fixed percentage of policyholder surplus. Option D is incorrect because group captives must still meet risk-based capital requirements, though their structures may differ. Question 2. Mr. Brown operates a group captive insurance company in Indiana. The company is considering changing its business model to operate as a single-parent captive. What is one of the primary regulatory differences between a group captive and a single-parent captive in Indiana? A. A single-parent captive must be more heavily capitalized than a group captive. B. Group captives are not subject to Indiana state insurance tax, while single-parent captives are. C. Single-parent captives are not required to submit actuarial reports, while group captives are. D. Group captives have more stringent requirements for policyholder surplus than single-parent captives. Answer A. Explanation. In Indiana, the regulatory framework for captive insurance companies recognizes different capital requirements based on the type of captive. A single-parent captive, which insures the risks of one organization or a closely related group of organizations, generally requires more capital to ensure it can withstand its risk exposure. Group captives, which pool risks from multiple unrelated organizations, often have lower individual capitalization requirements as the risks are spread across a larger number of policyholders. Option A is correct because single-parent captives typically have higher capitalization requirements than group captives due to the concentrated risk exposure. Option B is incorrect because both group captives and single-parent captives are subject to Indiana's state insurance tax. Option C is incorrect because both types of captives are generally required to submit actuarial reports to maintain regulatory compliance. Option D is incorrect because the requirements for policyholder surplus are not significantly more stringent for group captives compared to single-parent captives. Question 3. Scenario-based. Mr. Davis, the CFO of a large corporation, is tasked with forming a captive insurance company to manage his company's risks. The company is considering whether to form a single-parent or group captive insurance company. Mr. Davis has identified that their primary risk exposure is in their manufacturing operations, which are highly specialized and not shared with other companies. Which of the following would most likely be the best option for Mr. Davis's company? A. Forming a group captive insurance company to spread risk with other businesses. B. Forming a single-parent captive insurance company to manage its specific risk exposures. C. Operating without a captive insurance company and using a traditional insurance provider. D. Forming a group captive insurance company to reduce initial capital investment requirements. Answer B. Explanation. Given that Mr. Davis's company has highly specialized risk exposures in its manufacturing operations, a single-parent captive insurance company would be the most appropriate option. A single-parent captive allows a company to tailor its insurance coverage to its specific needs, especially when the risks involved are unique to that company. It would give the company more control over its insurance costs and claims management, as well as the ability to accumulate surplus capital. Option B is correct because a single-parent captive is designed to address the specific risks of one company, especially when those risks are not shared with other businesses. Option A is incorrect because a group captive which pools risks with other businesses would not be ideal if the company's risks are highly specialized. Option C is incorrect because relying on a traditional insurance provider may not provide the same level of risk management flexibility as a captive insurance company. Option D is incorrect because while group captives may offer reduced initial capital requirements, they are not the best option for specialized risks unique to one company. Question 4. Which of the following is a primary reason why a company might choose to establish a captive insurance company? A. To avoid paying state insurance taxes on premiums. B. To gain better control over the risk management and claims process. C. To eliminate all of the company's risk exposures. D. To avoid submitting financial statements to the state regulator. Answer: B. Explanation. Captive insurance companies are primarily established to give businesses more control over their risk management processes, including the underwriting of risks, claims management, and the overall cost of insurance. Through a captive, a company can tailor its coverage, improve cash flow, and create a more flexible approach to handling its risks. Option B is correct because it directly addresses the key benefit of a captive insurance company. Option A is incorrect because while captives can potentially lower overall insurance costs, they are not exempt from state insurance taxes. Option C is incorrect because no insurance structure can eliminate all risk exposures, it can only manage or mitigate them. Option D is incorrect because captives are still required to submit financial statements and comply with regulatory reporting requirements. Question 5. In Indiana, what is the minimum capital requirement for a single parent captive insurance company? A. $100,000. B. $250,000. C. $500,000. D. $1 million. Answer: B. Explanation. Indiana law requires that a single-parent captive insurance company maintain a minimum capital of $250,000. This amount ensures that the company has sufficient funds to meet its obligations and maintain solvency in case of unexpected claims. This is a key regulatory requirement for the establishment of a single-parent captive in Indiana. Option B is correct as it reflects the state's minimum capitalization requirement for single-parent captives. Option A, C, and D are incorrect as they either underestimate or overestimate the actual requirement. Question 6. Mr. Carter operates a captive insurance company in Indiana, and he is considering offering reinsurance coverage for some of his policies. What must Mr. Carter insure in order to comply with Indiana regulations regarding reinsurance arrangements? A. The reinsurer must be licensed in Indiana or be recognized as a qualified reinsurer by the Indiana Department of Insurance. B. The reinsurance coverage must cover at least 90% of the total premiums collected. C. The reinsurer must only be based outside of the United States to ensure tax advantages. D. Mr. Carter must not enter into reinsurance agreements if his captive is a single-parent captive. Answer A. Explanation. According to Indiana regulations, any reinsurance arrangement entered into by a captive insurance company must involve a reinsurer that is either licensed in Indiana or qualified as an eligible reinsurer under the state's laws. This ensures that the reinsurance provider is financially sound and compliant with the regulatory requirements. Option A is correct because it adheres to this requirement. Option B is incorrect because Indiana does not impose a specific percentage requirement on the premiums covered by reinsurance. Option C is incorrect because the location of the reinsurer, domestic or foreign, does not impact its eligibility unless it is properly licensed or recognized by the Department of Insurance. Option D is incorrect because single-parent captives are allowed to enter into reinsurance arrangements if they meet the necessary legal and financial standards. Question 7. Scenario-based. MS Thompson, the risk manager for a large multinational company, is tasked with forming a captive insurance company in Indiana. After conducting a feasibility study, she determines that the company's risks are diverse, ranging from liability to property damage, but these risks are not shared with other businesses. Which type of captive insurance company should MS Thompson consider establishing for her company? A single-parent captive insurance company to handle the specific and diverse risks of the company. B. A group captive insurance company to pool risks with other companies. C. A protected cell captive to separate different lines of business. D. A reinsurance company to transfer risk to another insurer. Answer A. Explanation. MS Thompson should establish a single-parent captive insurance company because it allows the company to address its unique, diverse risks in a customized way. Single-parent captives are designed to ensure the specific risks of one company, making them ideal for companies with complex or specialized risk exposures. Option A is correct because it matches the company's needs for a tailored risk management solution for a variety of risks. Option B is incorrect because a group captive is used to pool risks with other companies, which would not meet the needs of a company with unique, non-shared risks. Option C is incorrect because a protected cell captive is typically used for segregating different types of risk or business lines within a single captive, but it's not the most appropriate choice here. Option D is incorrect because reinsurance is used to transfer risk to another insurer and would not involve creating a new captive. Question 8. Which of the following is true regarding the financial reporting and actuarial requirements for Indiana captive insurance companies? A. Captive insurance companies must submit actuarial reports annually, regardless of the level of risk exposure. B. Only captives with more than $5 million in premiums written are required to submit actuarial reports. C. Actuarial reports are optional if the captive is less than 5 years old. D. The Indiana Department of Insurance does not require any actuarial analysis for captives, regardless of their size. Answer A. Explanation. Under Indiana law, all captive insurance companies are required to submit an actuarial report annually to assess their financial stability and ensure that they are properly reserving for claims. This requirement applies regardless of the level of premiums written or the age of the company. The actuarial report helps the Indiana Department of Insurance evaluate the adequacy of the company's reserves and overall financial health. Option A is correct because it accurately reflects the legal requirement for all captives to submit actuarial reports annually. Option B is incorrect because actuarial reports are required regardless of the premium size, not just for captives writing more than $5 million in premiums. Option C is incorrect because actuarial reports are not optional based on the age of the captive. Option D is incorrect because the Indiana Department of Insurance does require actuarial analysis for captives. Question 9. Under Indiana's captive insurance regulations, which of the following actions is required for the initial formation of a captive insurance company? A. The company must submit a feasibility study and business plan to the Indiana Department of Insurance. B. The company must have a minimum of 10 shareholders to be considered a captive. C. The company must purchase insurance policies from at least 2 separate insurers. D. The company must be domiciled outside of Indiana to take advantage of favorable tax laws. Answer A. Explanation. When forming a captive insurance company in Indiana, the company is required to submit a feasibility study and business plan to the Indiana Department of Insurance. This is part of the licensing process and ensures that the company has a solid plan for managing its risks, financials, and operations. The feasibility study helps the department evaluate the company's likelihood of success. Option A is correct because it is a required part of the formation process under Indiana law. Option B is incorrect because captives can have fewer shareholders and there is no minimum of 10 required for a captive. Option C is incorrect because captives are not required to purchase insurance policies from multiple insurers. Option D is incorrect because Indiana allows captives to be domiciled within the state and there is no requirement to form the captive outside of Indiana. Question 10. Which of the following is a key benefit of captive insurance for a parent company? A. Captive insurance allows the company to insure risks at a higher cost than traditional insurers. B. Captive insurance eliminates the need for the company to follow state and federal insurance regulations. C. Captive insurance provides the company with more control over its insurance programs and risk management strategies. D. Captive insurance requires the company to purchase coverage for all of its risks, even those with minimal exposure. Answer C. Explanation. One of the main benefits of captive insurance is that it allows the parent company to retain more control over its insurance programs. Captives provide the flexibility to customize coverage and policies based on the company's unique risks, which traditional insurance companies may not be able to do. Captive insurance can also help companies better manage their risks and lower overall insurance costs. Option C is correct because it highlights the main benefit of captives. Control over insurance and risk management. Option is incorrect because captives often result in lower overall insurance costs, not higher costs. Option B is incorrect because while captives provide some regulatory flexibility, they are still subject to state and federal insurance regulations. Option D is incorrect because captives allow companies to tailor their coverage to their specific risk exposures, not requiring coverage for every potential risk. Question 11. Which of the following is a primary advantage of establishing a captive insurance company in Indiana? A. No regulatory oversight from the state insurance department. B. The ability to tailor coverage to the company's specific needs. C. Full exemption from state taxes on insurance premiums. D. Guaranteed profitability for the captive insurer. Answer B. Explanation. One of the primary advantages of establishing a captive insurance company in Indiana or any other domicile is the ability to tailor insurance coverage to the specific risks of the parent company. This flexibility allows the parent to address unique and often complex risks that traditional insurers might not cover. Option B is correct because it emphasizes the customization and flexibility that a captive offers. Option A is incorrect because captives are still subject to state regulation and oversight, especially in areas such as financial reporting and solvency. Option C is incorrect because captives are not fully exempt from state taxes, although they may benefit from favorable tax treatment. Option D is incorrect because establishing a captive does not guarantee profitability. Success depends on effective risk management and underwriting. Question 12. Which of the following is a key consideration when determining whether a company should form a captive insurance company? A. The company must have a substantial amount of market share in its industry. B. The company must have the financial resources to fund the captive's claims and operations. C. The company must be located in a state with no regulatory requirements for captives. D. The company must purchase all of its insurance from external insurance providers. Answer B. Explanation. A company considering the formation of a captive insurance company must have the financial resources to fund the captive's claims and operational costs. Captives require a significant amount of capital to establish, and the company must be able to cover the costs of claims, operational expenses, and reserves. Option B is correct because financial strength is essential for the formation and operation of a successful captive. Option A is incorrect because market share is not a requirement for forming a captive. Of financial resources and risk management needs are more important. Option C is incorrect because captives must comply with the regulatory requirements of the domicile state, whether the state has minimal or strict regulations. Option D is incorrect because a captive's goal is often to reduce reliance on external insurers, not to purchase insurance from them. Question 13. Which of the following is true regarding the tax treatment of a captive insurance company in Indiana? A. Premiums paid to a captive insurance company are always tax deductible for the parent company. B. The captive insurance company is automatically exempt from federal income taxes. C. The parent company can deduct premiums paid to the captive insurance company subject to certain limitations. D. Captive insurance companies must pay both state and federal insurance taxes on premiums written. Answer C. Explanation. Under IRS regulations, premiums paid to a captive insurance company by its parent are generally tax deductible, but they must meet certain criteria. The premiums must be considered ordinary and necessary business expenses, and the captive must operate as a bona fide insurance company, not just as a tax avoidance strategy. Option C is correct because it reflects the tax deductibility of premiums paid to captives under certain conditions. Option A is incorrect because there are limitations on the deductibility of premiums. Option B is incorrect because captives are not automatically exempt from federal taxes and they must comply with tax regulations. Option D is incorrect because while captives may be subject to taxes on their income, they are not always subject to both state and federal taxes on premiums. Question 14. Mr. Lee is setting up a captive insurance company in Indiana. He is considering using the captive to cover his company's liability risks, but he is unsure about the minimum capital requirements for this type of business. What is the minimum capital requirement for a captive insurance company in Indiana? A. $100,000. B. $250,000. C. $500,000. D. $1 million. Answer B. Explanation. In Indiana, a captive insurance company must maintain a minimum capital of $250,000 for the initial formation. This is designed to ensure that the captive has sufficient capital to meet its financial obligations and risks. Option B is correct because $250,000 is the minimum required for a captive to be formed in Indiana. Option A is incorrect as it is too low to meet the minimum requirement. Option C is incorrect because $500,000 is not required for a standard captive. Option D is incorrect because $1 million is above the required amount. Question 15. Scenario-based. A company's executives are considering the creation of a captive insurance company. The company has a diverse set of risks, including property, general liability, and workers' compensation. They would like to keep the risks within separate pools to minimize cross-contamination. Which type of captive insurance structure should they establish? A. A reinsurance captive. B. A single parent captive. C. A protected cell captive. D. A group captive. Answer: C. Explanation. A protected cell captive allows a company to segregate different types of risks into separate cells, which helps prevent cross-contamination of the risks. This structure would be ideal for the company because it allows for more targeted management of distinct risk categories like property, liability, and workers' compensation. Option C is correct because a protected cell structure meets the company's need for risk segregation. Option A is incorrect because reinsurance captives are designed to assume risk from other insurers, not for segregating internal company risks. Option B is incorrect because a single parent captive does not inherently provide separate pools for different risks. Option D is incorrect because a group captive is for multiple companies to share risk, and the company in this case seems to prefer a more controlled internal structure. Question 16. Which of the following is a typical characteristic of a group captive insurance company? A. It insures only the risks of the parent company. B. It is formed by multiple unrelated companies to pool risks and share costs. C. It operates as a fully independent insurer with no connection to its parent companies. D. It only covers the property risks of the parent companies. Answer: B. Explanation. A group captive is formed by multiple unrelated companies that pool their risks together. This allows them to share the cost of insurance and access better pricing and coverage than they might individually. Group captives are particularly useful for small and medium-sized businesses that want to manage their risks more efficiently. Option B is correct because group captives pool the risks of multiple companies to spread costs and risks. Option is incorrect because group captives insure the risks of more than one company. Option C is incorrect because group captives are closely related to their parent companies and share risks. Option D is incorrect because group captives typically cover more than just property risks. Question 17. What is the primary purpose of a feasibility study when establishing a captive insurance company in Indiana? A. To determine if the company can afford to pay the captive's premiums. B. To assess the financial viability and long-term sustainability of the captive. C. To establish the amount of premium to charge the captive's clients. D. To evaluate the potential profitability of the parent company's business. Answer: B. Explanation. The primary purpose of a feasibility study is to assess the financial viability and sustainability of a captive insurance company. It helps the parent company determine whether forming a captive is a financially sound decision by evaluating the company's risk exposure, capital requirements, and long-term financial prospects. Option B is correct because the feasibility study's goal is to evaluate the financial viability of the captive. Option A is incorrect because a feasibility study assesses more than just the ability to pay premiums. Option C is incorrect because the premium rates are typically determined after the feasibility study. Option D is incorrect because the focus of the feasibility study is on the captive's financial sustainability, not the profitability of the parent company. Question 18. In Indiana, how often must a captive insurance company submit its annual financial statements to the state's Department of Insurance? A. Every 6 months. B. Once a year within 120 days of the end of the fiscal year. C. Every 2 years. D. Monthly. Answer: B. Explanation. Indiana law requires captive insurance companies to submit their annual financial statements to the Department of Insurance within 120 days after the end of their fiscal year. This ensures that the department can review the financial health and solvency of the captive. Option B is correct as it aligns with Indiana's reporting requirements for captives. Option is incorrect because financial statements are required annually, not every 6 months. Option C is incorrect because captives must submit annual reports, not biennial ones. Option D is incorrect because monthly financial reporting is not a requirement for captives in Indiana. Question 19. What is one of the key reasons why a company might choose to create a protected cell captive? A. To avoid paying taxes on premiums. B. To segregate different risks into separate cells for more targeted risk management. C. To pool risks with other companies without sharing profits. D. To eliminate all regulatory oversight. Answer: B. Explanation. A protected cell captive allows the company to segregate different types of risks into separate cells. This structure helps ensure that the financial performance of one cell, e.g., property risks, does not impact the other cells, e.g., liability risks. It provides greater flexibility and control in managing different types of risk. Option B is correct because the primary benefit of a protected cell captive is the ability to segregate different risks into distinct cells, allowing for targeted and efficient risk management. This structure ensures that the financial performance of one cell, e.g., property risk, does not negatively affect the performance of other cells, e.g., G. Liability risk, thus providing more control and reducing the potential for cross-contamination of risks. Option is incorrect because a protected cell captive does not automatically eliminate taxes on premiums, and tax considerations depend on the jurisdiction and regulatory framework. Option C is incorrect because protected cell captives are typically used by a single company or related entities to segregate risks, not to pool risks with unrelated companies. Option D is incorrect because protected cell captives still operate under regulatory oversight, though the oversight may differ depending on the jurisdiction. They are not exempt from regulation. Question 20. What is a potential disadvantage of using a group captive insurance company? A. The company has complete control over all insurance operations. B. All companies within the group share both profits and losses. C. Each company within the group is treated as a separate risk pool. D. The group captive offers unlimited coverage for all types of risks. Answer B. Explanation. In a group captive insurance company, all participating companies share both the profits and the losses. While this can provide cost savings and collective benefits, it also means that one company's poor risk management can lead to financial strain on the entire group. This is a disadvantage compared to a single parent captive where the risks and rewards are confined to the parent company. Option B is correct because the shared nature of profits and losses in a group captive can be a disadvantage if one member company experiences significant claims. Option A is incorrect because in a group captive, control is shared among all members, not held entirely by one company. Option C is incorrect because in a group captive, risks are pooled together rather than being segregated. Option D is incorrect because a group captive does not offer unlimited coverage. It is subject to the collective terms and conditions of the group. Question 21. When forming a captive insurance company, what is one of the primary factors a company should evaluate during the feasibility study? A. The availability of external reinsurance markets. B. The company's ability to manage and handle claims internally. C. The parent company's ability to completely self-insure all risks. D. The financial stability and underwriting capacity of the captive. Answer D. Explanation. During the feasibility study, one of the primary factors a company should evaluate is the financial stability and underwriting capacity of the proposed captive insurance company. This includes ensuring that the captive will have enough capital to cover potential claims and that it can meet regulatory requirements. Option D is correct because assessing the financial stability and underwriting capacity is essential to ensure that the captive can operate successfully and meet its obligations. Option is incorrect because while external reinsurance markets can be considered, they are not the primary focus of a feasibility study. Option B is incorrect because the feasibility study focuses on the viability of the captive itself, including its financial and operational capacity, not just internal claims management. Option C is incorrect because a feasibility study assesses the financial viability of a captive, which may not necessarily involve complete self-insurance of all risks. Question 22. Which of the following types of risk is often considered most suitable for coverage by a captive insurance company? A. Risks that are standard and readily covered by traditional insurers. B. High-frequency, low-severity risks that are inexpensive to insure. C. Unique or complex risks that are difficult to insure through the commercial market. D. Risks that do not require any financial reserves for claims. Answer C. Explanation. Captive insurance companies are typically used to cover unique or complex risks that are difficult or expensive to insure through the commercial insurance market. These may include specialized operational risks, environmental risks, or emerging risks that traditional insurers may not be willing to underwrite. Option C is correct because captives are ideal for covering unique or complex risks that are difficult to insure commercially. Option is incorrect because captives are generally not necessary for risks that can be easily covered by traditional insurers. Option B is incorrect because captives are more suited for covering high-severity, low-frequency risks rather than high-frequency, low-severity risks. Option D is incorrect because a captive insurance company must maintain reserves to cover potential claims, so cannot cover risks that do not require financial reserves. Question 23. Which of the following is a potential benefit of using a captive insurance company for a business? A. Complete elimination of insurance premiums. B. Improved risk management and more control over claims handling. C. Guaranteed coverage for all types of risks at no cost. D. Exemption from all regulatory requirements and taxes. Answer B. Explanation. One of the primary benefits of using a captive insurance company is improved risk management and greater control over claims handling. By managing its own insurance, the parent company can tailor coverage to its specific needs, retain more risk, and have more influence over how claims are processed. Option B is correct because captives provide enhanced control over risk management and claims handling. Option A is incorrect because captives do not eliminate insurance premiums, they merely allow the company to internalize the risk and manage costs differently. Option C is incorrect because captives do not guarantee coverage for all risks at no cost. Coverage is still subject to underwriting and risk assessment. Option D is incorrect because captives are still subject to regulatory oversight, including financial reporting and solvency requirements, and may not be exempt from taxes. Question 24. What is the primary reason for a company to choose a reinsurance captive? A. To assume direct responsibility for the company's primary insurance risks. B. To take on the risk of insuring other companies or insurers. C. To cover risks that are not available in the commercial insurance market. D. To allow the company to avoid paying premiums entirely. Answer: B. Explanation. A reinsurance captive is established to assume the risk of insuring other companies or insurers, typically as a way to reduce insurance costs and improve risk management for both the captive and its reinsurers. These captives generally provide reinsurance coverage for risks that are shared or transferred from other insurers or companies. Option B is correct because a reinsurance captive assumes risk from other companies or insurers. Option A is incorrect because reinsurance captives do not typically handle primary insurance risks but focus on reinsurance. Option C is incorrect because reinsurance captives are specifically designed to handle reinsurance, not to cover risks not available in the commercial market. Option D is incorrect because reinsurance captives do not eliminate premiums entirely. They provide a mechanism to manage and mitigate the cost of premiums through reinsurance arrangements. Question 25. Which of the following is an essential element for a captive insurance company to be considered a legitimate insurance company under Indiana law? A. The captive must operate in multiple states and countries. B. The captive must be able to demonstrate that it is engaged in the business of insurance, including assuming risk. C. The captive must provide coverage for all types of risks, including non-insurance related risks. D. The captive must provide dividends to its parent company every year. Answer: B. Explanation. For a captive insurance company to be considered a legitimate insurance company under Indiana law, it must be engaged in the business of insurance, which includes assuming and underwriting risks. Captives must operate as real insurance companies, providing coverage for specified risks and managing claims. Option B is correct because a captive must assume and underwrite risk to be considered a legitimate insurance company under Indiana law. Option A is incorrect because captives do not need to operate in multiple states or countries to be valid, they can operate within a single jurisdiction. Option C is incorrect because captives typically focus on providing coverage for specific risks rather than non-insurance related risks. Option D is incorrect because paying dividends to the parent company is not a requirement for a captive to be legitimate. Its primary function is to assume and manage risk. Question 26. What is one of the key advantages of using a fronting arrangement in a captive insurance structure? A. It eliminates the need for the captive to maintain any reserves. B. It provides the captive with access to a broader range of reinsurance options. C. It allows the parent company to avoid paying any insurance premiums. D. It helps the captive to remain compliant with regulatory requirements by using a licensed insurer. Answer: D. Explanation. A fronting arrangement allows a captive to use a licensed insurer to issue policies, thus ensuring that the captive meets regulatory requirements in jurisdictions where it is required to have coverage from a licensed insurer. The fronting insurer assumes the risk on paper, but the captive ultimately retains the risk through a reinsurance agreement. Option D is correct because the fronting insurer helps ensure that the captive remains compliant with regulatory requirements. Option A is incorrect because the captive still needs to maintain reserves for potential claims even in a fronting arrangement. Option B is incorrect because while fronting can provide access to reinsurance, the primary advantage is regulatory compliance. Option C is incorrect because fronting does not eliminate the need for premiums. It simply facilitates regulatory compliance while the captive assumes the actual risk. Question 27. What type of insurance coverage is often the primary reason for a company to establish a captive insurance company? A. Standard liability coverage that is easily available in the commercial market. B. Complex or high-risk coverage that is difficult or expensive to obtain from traditional insurers. C. Coverage for employees' health benefits and retirement plans. D. Personal property insurance for assets located in foreign countries. Answer: B. Explanation: captive insurance companies are typically established to cover complex or high-risk insurance needs that are difficult or expensive to insure through traditional markets. This may include risks like environmental liability, product recall, or other niche areas that commercial insurers may either refuse to cover or offer at a high cost. Option B is correct because captives are often used to manage complex or high-risk coverage that is not easily available in the commercial insurance market. Option A is incorrect because captives are generally not used for standard coverage, which is easily available in the commercial market. Option C is incorrect because employee health and retirement plans are usually managed separately from captive insurance arrangements. Option D is incorrect because captives are generally not used for personal property insurance but for business-related risks. Question 20. What is the typical capital requirement for a captive insurance company in the United States? A. A fixed amount that cannot be adjusted based on the size of the parent company. B. Varies depending on the domicile state and the risks being insured. C. A small fixed amount required to form the captive. D. An amount equal to the parent company's total assets. Answer: B. Explanation: the capital requirement for a captive insurance company varies depending on the domicile state and the risks the captive is insuring. Each jurisdiction has its own regulatory framework that outlines the minimum capital required for a captive to operate legally, and the amount can be adjusted based on the specific circumstances and the nature of the risks covered. Option B is correct because the capital requirements for a captive are not uniform and depend on factors such as the domicile state and the type of risks being covered. Option A is incorrect because capital requirements can vary based on the size and scope of the risks being insured. Option C is incorrect because the capital requirement is typically higher than a small fixed amount. Option D is incorrect because capital requirements are not based on the total assets of the parent company but rather on the risks covered by the captive. Question 29. What is a common feature of a single parent captive insurance company? A. It provides coverage to multiple unrelated businesses. B. It is primarily owned by a single parent company which assumes all the risks. C. It is established to insure the risks of an employee benefit plan. D. It is structured to avoid regulatory oversight by operating internationally. Answer: B. Explanation: a single parent captive insurance company is owned and controlled by one company, the parent company, and is set up to insure its own risks. This structure allows the parent company to have greater control over its insurance programs and can lead to cost savings through direct access to insurance markets and improved risk management. Option B is correct because a single parent captive is owned by one company and insures only the risks of that company. Option A is incorrect because a single parent captive only insures the risks of the parent company, not unrelated businesses. Option C is incorrect because single parent captives are typically not set up specifically for employee benefit plans, which have separate regulatory considerations. Option D is incorrect because while single parent captives are often established in jurisdictions with favorable regulations, they are still subject to oversight and must comply with the laws of their domicile. Question 30. Which of the following is a potential drawback of using a captive insurance company for a business? A. The ability to completely eliminate all insurance premiums. B. The business must manage the captive's day-to-day operations and claims process. C. The business can transfer all risk to the captive without retaining any responsibility. D. The business is exempt from all regulatory requirements. Answer: B. Explanation: one potential drawback of using a captive insurance company is that the business must manage the captive's operations, including underwriting and claims handling. This requires a certain level of expertise and resources to ensure that the captive is run efficiently and meets all regulatory and financial obligations. Option B is correct because managing a captive requires time, effort, and expertise to handle day-to-day operations and claims processes. Option A is incorrect because captives do not eliminate all insurance premiums. They still require capital and risk retention. Option C is incorrect because the captive is designed to retain risk, not transfer it entirely. The parent company still maintains some level of responsibility for managing and funding the risks. Option D is incorrect because captives are still subject to regulatory oversight, even though they may benefit from more flexibility than traditional insurers.